Welcome back to Talk Tickers. It's Friday, February 20th, 2026.
A very green Friday for some people.
Oh, man, yeah. There's this specific kind of silence that happens on Wall Street right before a major thesis breaks.
Right.
It's that moment when everyone is staring at the exact same screen, waiting for a single number to drop. The number that confirms whether an entire industry is dead or actually alive.
The hold your breath moment. The moment where the rubber finally meets the road.
Exactly. And for the last 18 months or so, the contact center industry, so, the companies that make the software for customer service agents, they have been collectively holding their breath.
Yeah, because the narrative was already written for them. The ink was completely dry on this one.
Right. The story was basically generative AI is the meteor and these contact center companies are the dinosaurs.
It was the AI death thesis, which is, it's simple, right? Elegant, and absolutely terrifying if you're long the stock.
Very terrifying.
The logic was just, if AI replaces humans and your business model relies on charging a software license per human seat, well, you go to zero. It was an existential crisis, just totally priced into a stock ticker.
Well, welcome back to the deep dive, everybody.
Yep.
Because yesterday morning, the dinosaur didn't just survive the meteor. It actually caught it and threw it right back.
You really did.
We are looking at NICE LTD today, ticker NICE. They dropped their Q4 2025 earnings yesterday. And, well, if you were looking at the chart this morning, you just see a vertical green line.
Straight up.
The stock closed up over $13. That's a 13.25% surge to finish at $111.55.
And we have to talk about the volume there because the volume was double the average. Over 2.7 million shares traded hands.
That's not just retail, right?
No, that isn't just retail guys playing around on their phones. That is institutional capitulation. That's the actual sound of bears rushing to cover their shorts.
But we aren't here to just, read the ticker tape to you. We are here to understand why the market was so completely wrong.
Because it wasn't just an earnings beat.
Right. This was a total paradigm shift. So today we're going to unpack the numbers. We are going to look at this disconnect that the CEO kept talking about on the call.
Yeah, that was fascinating.
And we're going to figure out if this is just a dead cat bounce or the start of a whole new era for enterprise software.
There is a ton to get through because the actual mechanics of how they're making money from AI, it's quite different from what people expected.
It's not a replacement.
No, it turns out AI isn't a replacement for their software at all. It's a tax. It's a tax they are levying on their customers.
I love that framing. The AI tax. We're going to get deep into that. But first, let's just set the stage a little for you. It's early 2026. The market has been terrified that ChatGPT and all its cousins would just decimate the call center.
Right.
Why was the sentiment so uniquely bad leading into this specific print?
You really have to look at the wall of worry that they've been climbing. Since late 2023, early 2024, every single time a new large language model came out, contact center stocks took a massive hit.
Almost algorithmic.
Yeah, it was a totally linear assumption by the market. Better AI equals fewer human agents. Fewer human agents equals less revenue for NICE. So they were trading at multiples that suggested zero growth or even contraction.
So they were priced for liquidation, essentially.
The bar was buried underground. And then yesterday management came out and they didn't just step over the bar, they pole vaulted over it.
Who went on the offense?
Big time. The whole theme of the call was essentially, we are an AI company and the disruption is making us money, not taking it away.
Okay, so let's stop the victory lap for a second and look the actual scoreboard. Because narrative is super fun, but numbers pay the rent. Let's hit the headline financials.
Sure.
Revenue came in at $786.5 million for Q4. That is up 9% year over year.
Mm-hmm.
Now I have to play devil's advocate here for you for a second. 9%. We regularly deep dive on tech companies that grow 30, 40, 50%.
Oh, yeah.
In the startup world, if you grow 9%, you get a pivot or a funeral. Why should anyone be impressed by single digits?
Context is everything with this ticker.
Yeah.
You have to remember two key things here. First is the sheer scale. This is a multi-billion-dollar revenue base we're talking about. Turning a battleship that big takes time.
True.
But more importantly, look at the macro environment we're sitting in right now. We're in 2026. Interest rates are still relatively high. Enterprise software spend has been locked down completely. CIOs are literally sitting on their wallets.
Yeah, budget scrutiny is insane right now.
Exactly. So in a flat IT spending environment, growing 9% means you aren't just riding a wave. You are taking market share. You are eating someone else's lunch.
So they're stealing share. From whom? The old on-premise dinosaurs.
The on-premises donation, as I like to call it, that's still the biggest donor of growth for them. And this actually leads us directly to the most important metric for the actual quality of this revenue.
Right. You can't just look at the top line, 786 million. You have to slice it open.
Exactly. How much of that is cloud?
Because cloud revenue is the sticky stuff. It's the recurring revenue that Wall Street will actually pay a premium for.
Yes. And cloud revenue hit $608.3 million. That is up 14%. But here is the actual stat that matters. Cloud is now 77% of their total revenue.
Why is that 77% number the magic threshold for them?
Because it mathematically means the transition is effectively over. For a decade, NICE has been dragging this incredibly heavy anchor of legacy on-premise hardware business.
Right, the old servers in the basement stuff?
Well, yeah. Every single quarter, the cloud side grew, but the legacy side shrank. So the total growth looked kind of flat. It masked the underlying engine.
Ah, I see.
Now that legacy piece is so small that it physically can't drag down the average anymore. The anchor is officially cut.
So mathematically, the drag from the old dying business is gone. They are now purely a cloud software company.
Precisely.
Yeah.
And a pure cloud company deserves a significantly higher multiple from Wall Street.
Let's talk about the bottom line then.
Yeah.
Because growing revenue is super easy if you sell dollar bills for 50 cents.
Anyone can do that.
So are they actually profitable?
Extremely profitable. Non-GAAP EPS came in at $3.24. That beat the street, and it's up 7% year over year. But the number I absolutely love here is operating cash flow.
Cool. What was it?
$179.7 million in the quarter alone.
Wow. That's a cash machine.
It really is. And this is where the AI death thesis starts to really crumble if you look closely. Dying companies usually burn massive amounts of cash trying to pivot. NICE is generating cash while pivoting.
That gives them so many options.
It allows them to buy companies, which we'll talk about when we get to Cognigy, and it allows them to buy back their own stock.
Which they did. A massive buyback authorization that we'll touch on later. But before we get to the capital allocation, we have to talk about the number that I think actually caused the short squeeze yesterday.
You mean the ARR?
The mic drop metric.
Yeah.
$328 million annual recurring revenue specifically from artificial intelligence. That is up 66% year over year.
This was the number everyone on the street was waiting for.
But hold on. I want to be super skeptical here for the listener. In software, companies just love to throw the term AI revenue around to juice their valuation.
Oh, yeah. AI washing is everywhere.
Exactly. Sometimes that just means, oh, we sold a database that stores some data used for AI, or they just reclassified some ancient analytics product as AI.
Right.
Is this real net new revenue, or is this just accounting gymnastics?
That is exactly the right skepticism to have. But if you actually look at the definitions management provided, NICE-E is categorizing this as direct monetization of generative AI features.
Meaning what exactly?
Specifically, their Enlighten products and their new bot capabilities. This isn't storage. This is a customer paying an extra explicit fee on top of their human seat license to have a summarization bot running in the background.
So this goes right back to the tax thesis.
Exactly. The bear case was that AI would replace the seat outright. The bull case was that AI is a tax on the seat. This $328 million proves the tax is actually being collected.
It's additive.
Completely additive. The customer is paying, say, $100 for the agent and now an extra $20 for the AI copilot.
And that $328 million makes up about 13% of their total cloud revenue right now. So it's not a cute little science project anymore. It's a highly material part of the business.
It creates a floor for the stock price. If you have a business segment growing 66% inside your main business, you just can't value the company like a slow growth utility stock anymore.
So let's unpack this AI disconnect, because this was a huge part of the earnings call. Scott Russell, the CEO, didn't mince words at all.
No, he came out swinging.
He basically called out the market directly. He said there is a massive disconnect between investor fear and customer reality.
He was very direct. He's basically arguing that Wall Street has a fundamental, total misunderstanding of how a real enterprise contact center actually runs.
Wall Street thinks AI bot enters, human leaves, one for one.
Right. And reality is AI bot enters, human stops drowning.
Explain that dynamic for us.
So most contact centers out there are completely overwhelmed. They regularly deal with 20% turnover. They have hour-long wait times during peaks. They are essentially operating in a constant state of crisis management.
Anyone who has ever called an airline knows this.
Exactly. So Russell's data shows that when customers deploy AI, they aren't turning around and firing people. They are using the AI to soak up the volume spikes so the humans can actually handle the complex, frustrating issues without burning out and quitting.
So it's not deflationary yet. It's stabilizing.
It's a capacity releaser. Management was very, very specific on the call. They are seeing absolutely no seat erosion in their installed base. None.
That is a wildly bold statement to make on an earnings call. None.
It is. Now, is that permanent? That's the real debate. But for right now, the cliff that everyone thought we were driving off of, it's just not there.
Let's dig deeper into the platform versus point solution war. Because to me, this is really the crux of the bull case for NICEA.
Yeah, this is a battlefield.
The CEO says customers are coming to them for a unified platform. But I look at the startup market, and I see incredible, cheap, highly specialized bots everywhere.
Sure.
I can go to an AI startup right now and get a customer service bot for pennies on the dollar compared to what NICE charges. Why on earth wouldn't a CIO just buy a cheap bot? Why pay the NICE premium?
It's a totally valid question. And if you are running a local flower shop, you definitely buy the cheap bot. But Russell's argument, and frankly the data supports this, is all about governance at scale.
Governance. That sounds like corporate speak for red tape.
It is. But it's really expensive, necessary red tape. Imagine you are a major bank or a massive healthcare provider. If your cheap startup bot hallucinates a mortgage rate that doesn't actually exist, or it promises a patient a refund that is completely against policy, or starts swearing at a customer because it got jailbroken by a prompt injection, you are liable. You get sued.
The brand damage alone is terrifying.
Exactly. So NICE isn't necessarily selling the absolute smartest bot on the market. They are selling the safest bot. They are selling the guardrails.
Yeah, so they are basically the compliance officer of AI for customer service.
That's a really great way to put it. They are monetizing fear. The fear of the rogue AI is exactly what sells the enterprise platform. Complexity is their best friend right now.
Because CX customer experience is just messy.
So messy. It needs orchestration. You need the bot to securely know who the customer is, what their billing history is, and most importantly, when to shut up and just transfer to a human.
And stitching all that together with 5 different cheap startups via APIs is just a nightmare.
It's the Frankenstein problem. You spend so much money and time trying to glue the cheap parts together that you completely lose any of the cost savings you thought you had.
Right.
And management explicitly claimed their win rates are actively improving against these point solutions. They are seeing customers who tried the cheap stuff, failed miserably, and are now coming crawling back to the integrated platform.
Speaking of winning, there's a really interesting data point regarding the CRM killer story on the call. This felt like a very direct shot at Salesforce or ServiceNow.
Oh, it absolutely was. A shot across the back.
Detail that for us.
They highlighted a specific win with a massive North American consumer services company. This company explicitly ripped out an AI solution from a, quote, CRM provider, and we can read between the lines there, and replaced it with NICE.
But why? If you already have the CRM, why wouldn't you just use their native AI add-on?
Because the CRM AI is usually totally disconnected from the actual telephony. It's disconnected from the real-time voice conversation. The customer in this case wanted a unified platform where the self-service chatbot and the human agent's co-pilot shared the exact same brain.
They didn't want 2 different brains fighting for the context data.
Exactly. And the trend they cited to back this up was massive. 100% of their new 7-figure deals in Q4 included AI.
100%.
Yes. That means AI is now officially table stakes. It's no longer a neat little upsell. It's the core of the entire deal.
Let's transition to talk about Cognigy. They acquired this company back in September 2025. This is their big play for agentic AI.
Right.
What is the actual difference between the AI they had before and agentic AI?
Great question, because the terms get muddy. The AI they had before was mostly a co-pilot model. That means it helps the human. It summarizes the call, it maybe suggests an article to answer a question. It essentially sits in the passenger seat and navigates.
Right, helping the agent.
Agentic AI, which is what Cognigy brought to the table, sits in the driver's seat. It talks directly to the customer without any human involved at all. It takes actions. It is autonomous.
So this is the actual replacement threat.
Yes, but by acquiring Cognigy, NICE now owns the threat. They own the digital door, the autonomous bot, and they own the human door, the agent software.
That feels strategically crucial.
It is. If you own both, you completely control the handoff. If the bot gets stuck, it seamlessly passes all the context and history to the human. If you use a third-party bot, that handoff is usually where the customer gets frustrated, has to repeat themselves, and hangs up.
They also mentioned something called the Cognigy simulator on the call, which honestly sounds like a sci-fi ride at a theme park. But I gather it's for testing.
It's brilliant, actually. It directly appeals to that risk-averse enterprise buyer we just talked about. It's a virtual lab.
How does it work?
You can spin up your new AI agent and have it interact with thousands of simulated customers, which are basically other AI bots playing the role of really angry, confused customers just to see how your agent behaves under stress.
Wait, so you have AI bots yelling at other AI bots to test the system?
Welcome to 2026.
Yes.
That is wild.
But it solves a huge bottleneck. You cannot test a beta bot on real live customers without risking massive brand damage. The simulator lets you stress test the agent in a sandbox before it ever takes a single live phone call.
That's a massive selling point for big banks and insurers who are terrified of compliance breaches.
Huge. It takes the fear out of deployment.
Okay, so they are clearly winning the platform war. They have the tech stack with Cognigy. But where is the actual sustained growth going to come from? We established the on-premises donation is a source, but isn't basically everyone on the cloud by now? I feel like we've been talking about this cloud migration for 10 years.
You live in a tech bubble, my friend.
I really do.
Yeah.
Guilty. Management highlighted a stat that honestly blew my mind. Only 40% of contact centers worldwide have migrated to CK's contact center as a service.
Only 40%.
40. That implies 60% of the global market is still sitting on old, dusty on-premise servers in a basement somewhere.
That is a massive amount of the market that is still totally up for grabs.
Exactly. The bear case firmly assumes the market is completely saturated and everyone is just fighting for scraps. This stat suggests we aren't even halfway through the basic migration cycle yet.
And what's going to force that 60% to finally move?
Here is the catalyst. It's AI.
How does AI force the migration?
Think about the infrastructure. You cannot run modern generative AI on an old server in your basement. The massive compute requirements, the constant API connections to the large language models, the real-time data piping, all of it requires cloud architecture.
So if you are a stubborn holdout and your CEO suddenly says, we need AI right now, you have no choice. You have to migrate to the cloud to get it.
You have to. So AI is the stick. It's no longer just a pitch about, oh, the cloud is marginally cheaper. It's now the cloud is literally the only way to stay relevant and survive.
AI is actively re-accelerating a 10-year-old migration cycle.
Precisely. And we are seeing this exact dynamic play out internationally in the numbers.
Let's talk about the international segment because the numbers there were just wild.
Yeah.
AMIA, so Europe, Middle East, Africa revenue grew 38%.
38% growth in a mature enterprise software company is practically unheard of.
And even on a constant currency basis, it was 32%.
Right.
Why is Europe moving so incredibly fast all of a sudden? Usually Europe is much slower to adopt new tech than the U.S.
Well, it's partly because they are starting from a much lower base. The U.S. is further along the adoption curve. International markets are significantly less penetrated by cloud generally.
So there's more low-hanging fruit.
Yes. Plus, consider the labor dynamics. Labor laws in Europe make it notoriously harder to hire and fire human agents to handle seasonal spikes. So the sheer efficiency gains from deploying AI are actually even more valuable there.
Makes total sense. And they mentioned two whales on the call, two massive deals.
Management called them the largest international deals ever.
Wow.
Historically, when NICE uses that specific language, we are talking about total contract value, TCV, in the hundreds of millions of dollars.
Like nation-state level deals.
Exactly. Large telcos, massive government agencies. And one of those huge deals actually went live earlier than expected in Q4, which helped boost these numbers.
That really shows execution speed, right? They aren't just selling the dream, they're deploying it fast.
Right. The implementation team is executing. And that leads us perfectly to the guidance.
Because Q4 is history. The stock moved 13% based on the future. What exactly are they telling us about 2026?
FY 2026 guidance. Let's look at the revenue. $3.17 billion to $3.19 billion. That is roughly 8% top-line growth.
And the EPS guidance is $10.85 to $11.05.
So the headline numbers are very solid, but the buried lead, the thing that really got analysts excited was the cloud growth acceleration.
Tell me about that.
They are forecasting cloud growth to accelerate to 14.5 to 15% in 2026.
Remember, it's 14% this past quarter.
Right. They are explicitly saying it's going to get faster.
That is incredibly rare. Usually, as a SaaS company gets a multi-billion-dollar revenue base, they mathematically slow down. The law of large numbers.
It is rare. And they broke it down for us. About 200 basis points, so 2% of that growth is coming directly from the Cognigy acquisition.
Okay.
But even if you strip that out entirely, the organic core business is still accelerating.
Now, there is always a catch with these things. To get this accelerated growth, they have to spend a lot of money. They explicitly called 2026 an investment year.
And historically, investors absolutely hate hearing that phrase.
Yeah. Investment year is usually corporate code for our margins are going to crash because we have to buy growth at any cost.
Exactly.
Why didn't the stock tank on that news? Why did it rip?
Because the stock was already so completely beaten down, investors are interpreting this as offensive confidence rather than just expense bloat.
Management actually said they are, quote, spending to win.
Right. They are actively pouring money into R&D, into sales and marketing to capture that international growth and heavily into their own AI infrastructure.
So margins are definitely going to be tighter in the first half of the year.
Yes. Margins will absolutely be compressed in H1. But here is the key. They are targeting the upper end of their 25 to 26% operating margin range by the end of 2026.
This is that exit velocity concept they talked about?
Exactly. They argue that as the new revenue scales throughout the year, the margins will aggressively expand in the second half to hit that target.
And they're putting their money where their mouth is on the stock itself, too.
Yeah.
Let's talk capital allocation. They announced a brand new $600 million share repurchase authorization.
That is a massive amount of ammo.
When you add in what they already had authorized but hadn't spent yet, they have roughly $1 billion in total dry powder for buybacks.
That is nearly 10% of the entire market cap.
It's a huge signal. It screams to the market we think our stock is ridiculously cheap.
And because they have an effectively debt-free balance sheet, they literally just repaid $460 million in debt that can easily afford to do this.
They aren't taking out loans to buy back stock. They're using pure free cash flow.
Right. Their FY25 free cash flow margin was 21%. They are printing cash.
So let's contextualize all this for the listener. Why the 13% pop? Was it genuinely just the fundamentals, or was it purely a mechanical squeeze?
It was a classic relief rally, violently combined with a short squeeze. You have to understand the market had aggressively priced NICE for death.
It was trading at a very low multiple compared to its historical average.
Right. When you price a tech company for permanent stagnation, and they show up with accelerating cloud growth and huge cash flows, the stock just has to mathematically re-rate higher.
And a short covering.
Oh, absolutely massive. There was high short interest going into this. When you see a $328 million AI ARR number print, if you are short because you firmly think AI is a scam or a fatal threat to them, you have to cover immediately.
That single number proves the short thesis is wrong, at least for the immediate term.
The CEO successfully regained narrative control. He reframed AI as a massive tailwind rather than a headwind.
But we have to be balanced here. We can't just drink the bullish Kool-Aid all day. What are the actual risks that remain? What keeps you up at night regarding this specific story?
Execution risk is number one. They just publicly promised 15% cloud growth. Now they actually have to go hit it.
Right. If they come in at 13% next quarter, the stock will absolutely get punished. They've raised the bar on themselves.
And macro is always a risk. They are deeply tied to enterprise software spend cycles. If the economy tanks and big companies just freeze all software buying AI or not, they will miss their numbers.
And what about that deflation ghost? Even if human seats aren't being cut right now, today, in 5 years, do we really need human customer service agents at all?
That is the ultimate long-term existential question for the industry. NICE argues they will seamlessly monetize the bot agents just as well as the humans.
But that is a totally unproven assumption at scale.
Completely unproven. We just don't know for sure if a software bot seat is genuinely as profitable as a human seat in the long run once the pricing models settle out.
Well, speaking of unproven assumptions and wildly irresponsible speculation, I think it is time.
Oh no, I know that exact look.
It is time for the part of the deep dive where we take off our responsible analyst hats, we put the spreadsheets safely away, and we put on our hedge fund cowboy hats.
I am bracing myself.
It is time for the This Is Not Financial Advice segment. Please, for the love of everything holy, do not actually trade on this. We are just brainstorming wild, plausible ideas. This is purely entertainment, not investment advice.
I am ready. Hit me. What is the pitch today?
Okay, imagine I am a junior analyst. I haven't slept in 3 days. I'm heavily caffeinated and pitching the investment committee at a very high-risk fund. I call this trade the Terminator arbitrage, or if you prefer, long the bot herder.
Long the bot herder. Okay, I'm definitely listening.
Here is the core concept. Everyone on the street is aggressively shorting the contact center because they think AI replaces humans.
Which is the consensus view.
Right. But they are completely missing the second order effect. The actual trade is long, nice, and heavily short the pure play AI startups.
So you are actively betting against the cool new kids, the startups with the massive venture funding, and betting on the legacy incumbent. That is incredibly contrarian.
It is. And here's the brutal logic behind it. Corporate IT departments are terrified. They're absolutely terrified of rogue AI. They simply do not want 50 different startup vendors running chatbots that might suddenly hallucinate, say something highly inappropriate, and get the Fortune 500 company sued.
That is a very real fear. We talked about this. Governance is everything.
Exactly. They want one single neck to choke if things go wrong. That neck is NICE.
Yeah.
And crucially, NICE owns the data.
The historical context.
Yes. They literally have 20 billion historical customer interactions sitting on their servers. The hot startups have the underlying models. They have Claude or GPT or whatever, but NICE has the actual business context to make those models useful.
The context is the real moat, not the intelligence.
Precisely. But here is the massive kicker. This is the margin supercycle theory. Let's assume the bears are totally right. Let's say in 2028, human customer service agents get fired en masse.
Okay, let's play out the doomsday scenario.
NICE currently charges for a human software seat. Let's say that seat costs the enterprise $40,000 a year in salary, plus the software license. NICE comes in and replaces that human with a Cognigy bot. They charge a new digital labor tax.
Right.
Maybe that bot seat only costs the customer $5,000 a year total. Huge savings for the customer.
So NICE top-line revenue drops dramatically. This is the exact deflationary spiral the bears are warning about.
Yes, revenue drops on the top line, but the gross margin on that digital bot is 95%.
Ooh.
There is no human employee to pay. There is no corporate cafeteria to subsidize. There is no HR department needed for a bot.
Right.
NICE suddenly becomes the world's absolute largest employer of digital labor. They are renting out tireless workers that essentially only cost them AWS electricity to run.
I see exactly where you were going with this. You are betting on a massive profitability explosion, even if the top-line revenue compresses a bit.
Exactly. It's purely a margin play. If revenue goes down, say 20% overall, but your operating margins go from 25% to 60%, the earnings per share will absolutely explode.
And the stock price historically follows the earnings.
100%. So the structure of the trade. You buy 2027 EPS long-term equity anticipation securities on NICE out of the money.
Okay.
You are betting that Wall Street finally wakes up to the fact that NICE isn't selling traditional software anymore. They are selling labor. And the global labor market is infinitely bigger than the software market.
It is diabolical. It fundamentally assumes that enterprise IT departments are incredibly conservative and that profit margins ultimately matter way more than top-line revenue growth.
And you fund this by shorting the AI startups because they actually have zero moat. The LLM models themselves are rapidly becoming free commodities. The price of raw intelligence is going to zero. The real enduring value is in the workflow and the data.
It's crazy enough that it might actually work. You are essentially betting heavily on the bureaucracy of AI.
The Terminator arbitrage. You heard it here first. Again, please do not do this. It is a terribly risky idea, but it's so fun to think about.
It certainly paints a vivid picture of the future. And it really highlights the massive asymmetry here. If management pulls off this transition, the upside is incredibly significant.
So let's wrap this up. We have thoroughly covered the earnings beat the cloud acceleration, the new AI tax dynamic, and some wild speculation. What is the final primary takeaway for the listener today?
Q4 was a definitive beat. The cloud business is accelerating, not slowing down. AI is translating into real hard revenue, $328 million of it. The death at the contact center was greatly exaggerated.
And the market aggressively rewarded them for proving it.
If you are closely watching the space, the core lesson from yesterday is simple. Don't bet against the incumbent company that actually owns the proprietary data. AI desperately needs data to work, and NICE has the data.
That's the bottom line. But before we sign off, I want to leave you with one final thought to mull over, something we didn't really touch on.
Let's hear it.
If the Terminator arbitrage actually plays out, and we get to 2028 where bots are handling everything perfectly, no wait times, zero latency, perfect empathy, what happens to the human consumer?
What do you mean?
Do we actually start preferring the bot? And if consumer preference totally flips and we hate talking to real humans, what does that do to the brand value of the companies buying this software? Does customer service just become a pure software arms race where the company with the best bot wins all the market share?
That is a terrifying and fascinating thought. The end of human-to-human brand loyalty.
Something to think about while you're on hold with your airline this weekend. Markets move fast, folks. Don't fight the tape. Keep talking tickers and we'll keep tracking the numbers. Thanks for joining us for this deep dive into NICE. We will catch you next time.